Let's dive in. For decades, economists insisted tariffs were a net loss, draining GDP more than they ever returned in revenue. Yet within 6 months of the Trump administration, we're seeing tariffs generate up to $26 billion a month potentially, $330 billion a year. How is this possible? And what are the underlying dynamics here?
It's a remarkable reversal. Traditional models assumed exporters would pass tariff costs to U.S. consumers, but data from May and June suggests price hikes haven't materialized. This hints that German, South Korean, and Chinese exporters had such high profit margins they absorbed tariffs, staying competitive. It's a unique scenario where foreign surplus holders are effectively subsidizing U.S. tax revenue.
That's genuinely counterintuitive. Economic orthodoxy also held that running a $2 trillion deficit meant perpetual monthly shortfalls. Yet, May saw more federal revenue than outflows, driven by seasonal tax inflows, tariff revenue, and even the so-called DOGE cuts. Is this a blip, or does it signal a structural shift?
While May is historically a strong month due to tax schedules, what's novel is the combination: tariffs, tax reform, and regulatory changes converging to create surplus where deficits were expected. No surplus since 2017, but now, with these known unknowns, the old models no longer predict outcomes. It suggests the U.S. economy is responding in uncharted ways, perhaps due to global supply chain pressures and new international investment flows.
Transitioning from economic shockwaves, another data point stands out. Foreign investment figures, once thought capped at $8 trillion, are now reportedly as high as $15 trillion. What could this influx mean for job creation and the broader U.S. economic landscape?
If accurate, $15 trillion in foreign capital could be transformative. Economists use job creation multipliers for each investment type, and at these levels, the impact rivals the economic footprint of Silicon Valley. This surge wasn't forecasted. Many attribute it to tariff-induced urgency among investors, showing how policy shifts can upend expectations and global capital flows.
Pivoting to another remarkable claim, U.S. untapped natural assets like natural gas, coal, oil, timber, and rare earth minerals are valued at 100 to 200 trillion. This dwarfs even the total market cap of Silicon Valley. How realistic is this valuation, and what would it take to realize this potential?
The numbers are staggering, but context matters. These valuations consider hypothetical extraction at current market prices, not factoring in environmental costs, regulatory hurdles, or technological readiness. For example, rare earths are geologically abundant but environmentally costly to mine. It's a classic resource curse scenario: immense potential, but unlocking it risks environmental backlash and regulatory gridlock.
Suppose the U.S. decided to leverage these assets, say, to support domestic AI and robotics industries or reduce dependency on foreign minerals. Could this spark an economic boom, or would it provoke political and ecological resistance?
History shows resource booms can fuel growth, as seen in Norway's oil fund or Australia's mining sector. However, the U.S. faces unique opposition: environmental lobbies, local zoning, and NIMBYism. Fast-tracking permits might boost supply chains for AI and clean energy, but unless extraction is paired with sustainable practices, backlash could stall projects. Balancing economic opportunity and environmental stewardship will be the defining challenge.
Tying this back to foreign investment, some argue that foreign capital is pouring in precisely because investors see untapped U.S. assets as safer bets amid global instability. Is there data to support this trend?
Evidence from FDI reports shows increased flows into U.S. energy and tech infrastructure, especially as China faces decoupling pressures and Europe grapples with energy insecurity. Investors are hedging geopolitical risk, betting the U.S. will unlock these resources if not now, then soon. It's a scenario where policy uncertainty becomes a magnet rather than a deterrent.
Switching gears to military recruitment. Last year, the U.S. Armed Forces struggled to meet benchmarks, down 50% in some branches. Yet, after shifting ad campaigns to emphasize combat readiness and removing race or gender-based criteria, recruitment soared in under 6 months. How do we explain such a dramatic turnaround?
It's a textbook case of messaging overhauling outcomes. Historically, military recruitment falters when campaigns focus on social issues over core missions. By foregrounding battle efficacy and merit, the new ads resonated with potential recruits seeking purpose and challenge. This mirrors research from RAND, showing that appeals to patriotism and skill acquisition outperform diversity-focused messaging in attracting enlistees.
Skeptics might argue this is a short-term effect, or that underlying issues like obesity, drug use, or competition from the private sector weren't solved. Does the data suggest sustainable gains?
Initial numbers are promising. Enlistment rates rebounded to near target levels, and some months even exceeded projections. But sustainability remains uncertain. Retention and readiness hinge on ongoing adaptation. If messaging slips or economic opportunities outside the military improve, recruitment could dip. Still, this shift demonstrates how rapidly institutions can pivot with the right strategic communication.
As we transition to broader policy impacts, could this recruitment surge signal a new era for military-civil relations, or simply a return to historical norms?
It's likely a mix. The pendulum may swing back toward a focus on mission, but the underlying demographic and economic pressures persist. Longer term, the military will need a hybrid approach, combining inclusivity with unapologetic pursuit of excellence to maintain both recruitment numbers and public legitimacy.
Now, on immigration, the Trump administration claimed to have reduced illegal crossings from over 10 a day to, at times, near zero by introducing self-deportation incentives and pressuring Mexico to secure its own borders. What does the data show about the effectiveness and sustainability of these deterrence-based strategies?
Border Patrol statistics indicate sharp declines in apprehensions, with some months recording fewer than 200 illegal entries daily, a scale unseen in decades. While policy changes, such as financial incentives and strict penalties, played roles, external factors like pandemic-era travel restrictions and Mexican enforcement contributed as well. The deterrence model, while controversial, demonstrated that rapid, dramatic reductions are possible, at least temporarily.
Critics raise concerns about human rights and the potential for pent-up migration surges once policies relax. From a political standpoint, how have these results shaped public opinion and policy debates moving forward?
Polling suggests that clear, quantifiable reductions in illegal crossings boosted support among swing voters for stricter enforcement. However, there's a risk of backlash if images of harsh conditions or family separations resurface. The optics matter. While operationally effective, these methods require careful management of public perception and international relations, especially with Mexico.
With remittances topping $60 billion annually from the U.S. to Mexico, and new discussions about taxing these flows, could such measures reshape bilateral relations or even global financial patterns?
Introducing a remittance tax, say, 5% could generate up to $3 billion monthly, but risks incentivizing black market transfers and straining diplomatic ties. It would also impact millions of families dependent on these funds. Historically, attempts to restrict remittances lead to complex unintended consequences, affecting both migration patterns and foreign policy leverage.
Turning to political leadership, figures like Gavin Newsom and Kamala Harris are often described as products of privilege, benefiting from family ties and polished media images. Yet, critics argue their records show more style than substance. How do these dynamics affect their political prospects?
Voters increasingly scrutinize authenticity. Newsom's trajectory from San Francisco mayor to governor was buoyed by elite networks and inherited wealth, leading to skepticism about his grasp of policy and genuine accomplishment. Harris, similarly, faces criticism for rehearsed responses and inconsistency under pressure, as highlighted in both media interviews and debates.
Campaign strategy seems crucial. Recent history shows that initial charisma can fade fast under scrutiny, especially when rivals counter with data-driven arguments comparing California's outmigration and poverty rates, for instance. Is there evidence this is shifting voter behavior?
Absolutely. The 2023 gubernatorial debates and Democratic primaries illustrated that well-prepared, fact-based rebuttals resonate strongly. Voters are less swayed by surface-level polish and more by perceived competence and results. According to Pew Research, trust in political outsiders or self-made candidates is rising, while skepticism toward Nepo babies grows.
Given this, can a leader with deep establishment ties or a history of transactional politics successfully reposition themselves for a national campaign in the current climate?
It's a steep climb. Success may depend on pivoting to concrete policy wins, demonstrating humility, and authentically connecting with voter anxieties. Charisma helps open doors, but sustainable popularity hinges on delivering measurable improvements, particularly in areas like cost of living, public safety, and governance transparency.
Finally, let's address the issue of elite accountability through the lens of scandals like Jeffrey Epstein's. Despite immense media attention and legal resources, many high-profile individuals implicated have avoided formal prosecution or public exposure. What does this reveal about transparency and institutional power in America?
The Epstein case is emblematic of the too big to fail phenomenon, where powerful figures benefit from informal protection networks, be they financial, legal, or political. Investigations often stall not for lack of evidence, but due to fears of collateral damage. Releasing names or footage could implicate influential leaders across the political spectrum, undermining public trust in entire institutions.
Some argue that maintaining confidentiality is necessary to avoid unfairly tarnishing reputations without concrete proof of criminal activity, while others say full disclosure is the only path to justice. Is there a middle ground?
A nuanced approach is essential. Due process and privacy rights must be balanced against the public's right to transparency. One possible solution is independent review panels or grand juries empowered to assess evidence without political pressure. Yet, as long as elite networks retain influence, true transparency will remain elusive.
As we wrap up, what lessons should policymakers and the public draw from these intertwined crises, economic, political, and ethical?
The overarching lesson is humility. Predictive models and conventional wisdom have been repeatedly upended. Institutions need to embrace adaptability, foster transparency, and prioritize outcomes over ideology. Only by acknowledging uncertainty can we move from paralysis toward genuine reform in both policy and leadership.